Today, we will talk about Bitcoin halving 2025, what it means for investors. Bitcoin halving is one of the most significant events in the cryptocurrency market, shaping the supply and demand dynamics of Bitcoin and influencing price trends. This event, occurring approximately every 4 years, reduces the block reward for miners, effectively slowing the rate at which new Bitcoin enters circulation. The next Bitcoin halving is expected to take place in April 2025, reducing the block reward from 3.125 BTC to 156.25 BTC per block. Historically, halvings have triggered significant bull runs, as the diminishing supply often leads to increased scarcity and higher prices. The 2012, 2016, and 2020 halvings all preceded substantial Bitcoin price rallies, drawing attention from institutional investors, retail traders, and financial analysts. Many investors believe the 2025 halving will have a similar impact, potentially driving Bitcoin to new all-time highs. However, market conditions, macroeconomic factors, and regulatory developments will also play crucial roles in shaping the post-halving market landscape. Understanding Bitcoin halving. Bitcoin operates on a proof-of-work consensus mechanism, where miners validate transactions and secure the network. As a reward for their efforts, they receive newly minted Bitcoin. However, every 210,000 blocks, approximately 4 years, the Bitcoin protocol cuts the block reward in half. This is programmed into Bitcoin's code to ensure that new Bitcoin is issued at a predictable and decreasing rate, ultimately capping the total supply at 21 million BTC. Since Bitcoin's inception in 2009, 3 halvings have occurred. The first halving in 2012 reduced the block reward from 50 BTC to 25 BTC, contributing to a significant price surge. The second halving in 2016 brought the reward down to 12.5 BTC, followed by another major bull run. The third halving in 2020 reduced the reward to 6.25 BT, leading to Bitcoin's rise to an all-time high of $69,000 in 2021. As the next halving approaches, many investors are watching closely to see if history will repeat itself. The potential impact on Bitcoin's price. Bitcoin's price is influenced by supply and demand dynamics. The halving reduces the rate at which new Bitcoin enters circulation, making the asset scarcer. If demand remains constant or increases, this scarcity can push prices higher. Historically, Bitcoin has experienced a price surge in the months and years following a halving event. Leading up to the 2025 halving, speculation and investor enthusiasm may drive Bitcoin's price upward, similar to previous cycles. Post-halving, the reduction in newly minted Bitcoin may intensify the supply shock, pushing prices even higher. Some analysts predict Bitcoin could reach $100,000 to $250,000 within a year or two of the halving, while others suggest that external factors such as regulatory developments, macroeconomic conditions, and institutional adoption will play a more significant role in shaping Bitcoin's trajectory. Mining economics and network security. Bitcoin miners are among the most affected by halvings, as their block rewards are cut in half, reducing their earnings. For miners to remain profitable, Bitcoin's price needs to increase significantly to offset the reduction in rewards. If prices do not rise enough, some miners may struggle to cover operational costs, leading to potential miner capitulation and reduced network hash rate. When miners exit the network due to lower profitability, Bitcoin's mining difficulty adjusts to maintain stable block production times. This ensures that the network remains secure and transactions continue to be processed efficiently. However, mining difficulty adjustments can create short-term volatility as miners adjust to the new economic conditions. Larger mining operations, with access to cheap electricity and efficient hardware, are likely to remain competitive, while smaller, less efficient miners may be forced to shut down. This consolidation of mining power could have implications for network decentralization and security, a factor investors should monitor closely. Institutional and retail interest in Bitcoin. Bitcoin halvings often serve as catalysts for increased institutional and retail investor interest. In recent years, Bitcoin has gained recognition as a store of value, similar to gold. Institutional investors, hedge funds, and publicly traded companies have started accumulating Bitcoin as part of their investment strategies, viewing it as a hedge against inflation and economic uncertainty. The 2025 halving could further strengthen Bitcoin's appeal to institutions. With fewer new Bitcoin entering circulation, scarcity-driven demand may encourage more corporations and investment firms to allocate funds to Bitcoin. The rise of Bitcoin exchange-traded funds, ETFs, has already made it easier for institutions to gain exposure to Bitcoin, and post-halving supply constraints could drive additional inflows. Market sentiment and volatility. Bitcoin halvings typically generate excitement and speculation, leading to increased volatility in the months leading up to and following the event. Market sentiment can shift rapidly, with periods of euphoria followed by corrections. Understanding these market cycles is essential for investors looking to navigate the halving effectively. Leading up to the halving, anticipation and bullish sentiment often push prices higher. However, after the event, short-term profit-taking can lead to temporary price dips. Historically, Bitcoin has entered extended bull runs 12 to 18 months after each halving, reaching new all-time highs. If this pattern continues, Bitcoin could experience a significant rally throughout 2026. Long-term investors often use halvings as opportunities to accumulate Bitcoin at lower prices before supply-driven price appreciation takes effect. Short-term traders, on the other hand, may attempt to capitalize on price swings, leading to increased market turbulence. Investment strategies for the 2025 halving. For investors looking to capitalize on the upcoming halving, accumulating Bitcoin before the event may be a strategic move. Dollar cost averaging (DCA), a method of investing a fixed amount at regular intervals, can help mitigate market volatility and reduce the risk of buying at peak prices. Diversifying into Bitcoin-related investments can also provide exposure to the potential post-halving price surge. Bitcoin mining stocks, blockchain infrastructure companies, and Bitcoin ETFs offer alternative ways to participate in the market without directly holding Bitcoin. Staying informed about regulatory developments, macroeconomic trends, and institutional investment activity is also crucial. The broader financial landscape, including interest rates, inflation, and global economic conditions, can impact Bitcoin's price movements post-halving. What do you think of our video? Let me know in the comment section below. Also, subscribe to our channel before you go. Thanks for watching.